Looming, a consumer recession and more earnings trouble, Burry tweeted. The investor sounded the alarm on the greatest speculative bubble of all time in all things back in June 2021, and warned buyers of meme stocks and cryptocurrencies were headed for the mother of all crashes. Barclays analysts said they now expected a 75 bps move from the Fed on June the 15th, rather than the 50 bps which has been baked in.
How will higher interest rates affect consumers?
Rising interest rates have a number of implications for consumers. First, they could slow housing sales, which would become the leading economic indicator that a recession is around the corner. The increase in interest rates will mean higher mortgage payments for some current homeowners, as well as those who are planning to buy a home in the near future. Furthermore, rising interest rates could lead to an increase in unemployment as firms experience a slowdown in activity.
Who else will be most affected by higher interest rates?
The stock market will likely be negatively affected, as it was when the last interest rate hike was announced. Consumers will see an increase in mortgage payments, car payments, and credit card payments. Rising interest rates will cause more problems. Rising interest rates, particularly short-term rates, could cause some equity investors to lose money. Higher interest rates will make all debt more expensive, which will affect households' ability to borrow more money in the future.
What happens after inflation becomes entrenched?
Inflation creates uncertainty among businesses and investors. It also makes debt more expensive, which can lead to defaults. This could slow economic growth and may even lead to a recession. If inflation becomes more persistent, the Fed may be forced to raise interest rates more aggressively to combat it. Michael Burry was clearly stating in one of his tweets that inflation will climb higher, squeezing consumers and weighing on asset prices and economic growth. Moreover, the hedge fund manager noted that Americans are saving less, borrowing more, and burning through the cash they stashed during the pandemic. He argued the U.S. economy is on borrowed time as a result, as consumer spending will plunge once household savings run out, hammering corporate profits and economic growth. According to Reuters, U.S. 2-year Treasury yields rose above 10-year borrowing costs on Monday, the so-called curve inversion that often heralds economic recession. On expectations, interest rates may rise faster and further than anticipated. Fears the U.S. Federal Reserve could opt for an even larger rate hike than anticipated this week to contain inflation sent 2-year yields to their highest levels since 2007. Money markets are now pricing a cumulative 175 bps in hikes by September 2022 and also see a 20% chance of a 75 bps move in the second week of June 2022, which if implemented would be the biggest single meeting hike since 1994. Once inflation sets in, it acquires its own momentum and isn't easy to break. The personal savings rate in April fell to 4.4%, the lowest since September 2008, as consumers spend more on almost everything. Inflation has battered consumer economic confidence, and one risk is that it will cause Americans to reduce purchases and slow the economy. A historically tight labor market has pushed up nominal wages, but worker pay isn't keeping up with prices. Real average hourly wages have fallen 3% over the last year, with 2/3 of that decline in the last 4 months. Rents have risen 5.2% over the last year, though housing websites estimate they're up double digits in most places. Travel has become much more expensive, as hotel, airline, and restaurant prices increase. Americans are often paying more for less as businesses scale back services, e.g., no daily room cleaning, amid labor shortages. Fed officials had signaled they were likely to raise rates by a half percentage point at their 2-day meeting next week and to continue doing so until inflation diminished. Mr. Powell in May said inflation had been too high. Separately, a University of Michigan survey of consumers' long-term inflation expectations rose to its highest level since 2008. The measure is very important to Fed officials because they believe such expectations can be self-fulfilling, heightening investors' fears that the Federal Reserve. Join this helpful Facebook group to learn about saving and investing now. Gain your financial knowledge in a quick and easy way.
How inflation works.
The standard measure of consumer price inflation is the Consumer Price Index, which is maintained by the Bureau of Labor Statistics. Inflation represents how much more expensive the relevant set of goods or services has become over a certain period, most commonly a year. The CPI is the most widely used measure of the price level in the United States. The CPI measures the average change in prices for a representative basket of goods and services purchased by households.
Reasons for the recent increase in inflation.
Inflation is likely to have been driven by a combination of factors. The forces driving prices up, such as war, the pandemic, supply chain disruptions, and surging demand from consumers and businesses, don't look to be going away anytime soon. Geopolitical and policy challenges are pushing up inflation and interest rates, which are contributing to financial market volatility. The United States has been experiencing labor shortages in key industries such as healthcare, construction, and logistics. This could be spurring companies to increase wages to attract and retain skilled workers. Higher commodity prices are also contributing to higher costs.
Strategies for investing your money during inflation.
Investors should consider their risk tolerance and investment horizon before making any changes to their portfolios. Someone with a low risk tolerance and a short investment horizon would want to avoid risky stocks.
What could trigger a recession?
A sharp rise in interest rates, or a prolonged increase, is the most likely trigger for a recession. A persistently high inflation could cause the Fed to hike interest rates more aggressively in an effort to slow the economy and prevent a recession from occurring.
Wage growth is barely keeping up with inflation.
The employment report recently released confirmed that wage growth is below the rate of inflation. Wage growth is an important indicator of how well the economy is doing and how well workers are doing. When wage growth is strong, workers have more money to spend, which helps boost the economy. Conclusion: inflation expectations are rising, and the Federal Reserve could soon raise interest rates again. The U.S. economy is facing the rising threat of a recession, triggered by the Federal Reserve's decision to hike interest rates. The key factors that will determine whether or not the economy is headed towards a recession are inflation, wars in Ukraine, and the yield curve. If inflation continues to rise, if the war leads to a significant loss in economic activity, the economy will enter a recession. Give us a like and comment below to let us know what you would like to learn more. This content is strictly for education purposes only. We do not provide any investing, tax, or legal advice whatsoever. Please consult with the professionals in order to make an informed decision for yourself about your situation and conduct it accordingly. Investing involves certain risks, including the possibility that you may lose money.